Let's do it. Please take a seat. This will be a very interesting conversation. We're kicking off Pacific Bitcoin, mining track. Marathon is a key sponsor. Thank you so much. Let me invite to join me this morning first Salman Kahn, Marathon CFO. Please join us. Patrick Fleury, CFO at TeraWulf. Phil McPherson, VP of Capital Markets at Riot, and Glenn Harrison, VP of Operations at Iris. Thank you so much. A round of applause, please.
Thank you.
Okay. Today's topic is mining treasury management, which might sound a little bit dry for a morning topic, but believe me, this will be a very interesting conversation. We have folks who are actually shaping this industry. The largest companies are on stage. They're actually helping to build this mining industry, which is a core element of the Bitcoin ecosystem. And we're going to be talking about a lot of very interesting topics of how this is shaping up. So before we kick it off, let's go across the panel here. Quick introduction. Tell me a little bit about yourself, the company you work for. Give me your Bitcoin class. When did you join the ecosystem? When did you buy it for the first time? Or when did you went down the rabbit hole? And tell me a little bit about the person you are the most proud of orange peeling, or the person you are the most disappointed for not being able to orange peel yet. Let's just get it started a little bit with a fun topic. So please, maybe, Salman, would you like to kick us off?
Yeah, thank you. Thank you, Guy, for having us here. It's look, I'm probably the least experienced in this panel when it comes to Bitcoin mining. My exposure to Bitcoin mining was a couple of years ago, not knowing much about the industry and not knowing how mining works, and going out and buying Bitcoin, hoping that I'll become rich. And along the way, learned a lot of things. And that was my exposure. But my background is oil and gas, which is spent about 15 years with large oil and gas companies like Occidental Petroleum, learning how commodity price cycle exposed industries operate. And there's a down cycle, there's a bear, there's a bull. And how do we prepare ourselves for the bear, and how do we prepare for the bull markets and be prepared to take the opportunity to grow from there. So that's my background and experience. Very happy and humbled to be here and learn along the way.
Great, thank you. Welcome.
You're welcome.
Hi, Patrick Fleury, CFO of TeraWulf. We definitely, is it hot enough in here for everybody? I feel like we got some miners running in the back here. Anyway, yeah, it does. Anyway, I'm a 22-year, mainly institutional investor, reluctant CFO, been doing this job for about a year and a half. To answer your question on Bitcoin, I read the Bitcoin Standard a few years ago, and that kind of got me hook, line, and sinker. So that's just my quick background. Phil.
Can you check the mic here? Yeah.
Check. All right. Yeah, Phil McPherson, Vice President of Capital Markets for Riot Platforms. I guess my intro to Bitcoin mining, I was a CFO of an oil and gas company, and we had some stranded gas assets. And so I started going down the rabbit hole on how to mine Bitcoin, what the cost would be, trying to use natural gas. And this was back in 2017 when it was around $3,000 a Bitcoin. And I realized that it was about the same cost to mine then as what you could get for Bitcoin. And oil and gas was hard enough. So I didn't really want to do something even harder at that time. And then it went to 21,000 and I was like, oh shit, maybe I missed something. So I went down the rabbit hole again in 2019, 20, kind of into the COVID when it sold off. And again, went back to that macro picture of what it cost to mine Bitcoin. And then I was introduced to Riot. They were looking for a CFO and I wound up joining the company in 2021 as the 8th employee, and now we have over 500 people and run one of the largest Bitcoin mining facilities in the world. So that's my background.
Awesome. Welcome. Glenn?
Hi, my name is Glenn Harrison, VP of Operations for Iris Energy. I went down the Bitcoin rabbit hole in 2017, bought at the top, 15, 20,000, lost a bit of money. and then got back into it 2019, 2020. Main reason I got orange pilled was like I worked in a bank, was in commodities for 14 years, and regulation just kept the bureaucratic machine just kept getting busier and busier, and the amount of regulation in the bank just didn't make sense to me. I didn't feel like we're adding value to society at large, and I felt like a decentralized nature of an algorithm just made a lot of sense. It just cut through a lot of that, so that's where it hit for me. Orange pilled from our founder, actually, Will Roberts, who I worked with at the time, and who I'm most proud to orange pill is probably indirectly through family. Put it in cold storage and the like. So, yeah.
Awesome, great. So let's kick it off. Let's get right into it. So the topic, as we mentioned, we're talking about treasury management, and we have very different views on how to manage your treasury. When to hold Bitcoin, when to sell Bitcoin. So maybe we kick it off with that question and we go across the panel again. Let's start from a philosophical perspective. What is each one of your company's approach about Bitcoin? Do you hold it? Do you sell right away? Is that the shareholder decision whether or not to be long Bitcoin or short Bitcoin, and the company just needs to generate that capital back to the investors? So I'd love to hear a little bit more about each one's perspective and how do you navigate that from a philosophical perspective and other key principles for treasury management that you're all applying on day to day. Maybe we start on the other back and then we can...
Yeah, sure. So we started mining Bitcoin in 2019. We've had a philosophy where we liquidate daily, and we've kept to that. We've had conviction right through a bull market and bear market. Through 2021, when the price ran up to 69,000, I think we were, from a publicly listed miner perspective, had the highest average sale price because we did liquidate on a daily basis. And there was a lot of public pressure to accumulate Bitcoin through that bull market, but we stuck to our guns. We essentially, we view the non-HODL philosophy as a way to invest in further capex, which we feel has a higher return on investment. It's where what we can control. We can control our own capex. That's why we're a Bitcoin miner. That's where we're trying to attract capital. And if we weren't selling the Bitcoin, we'd have to borrow, we'd have to leverage up, or we wouldn't be able to build as much as what we're building. So we're stacking the scarce asset that we can control, which is infrastructure, 20, 30-year infrastructure that we can use for multiple purposes, potentially not just Bitcoin mining, and that's what we think is the value add there. So, yeah.
At Riot, we started mining in 2017, and for the first 5 years, we stacked every coin that we mined. It was in 2022 that as we grew our hash rate, you go from operating less than an exahash to 5, 6, 7 exahash, your cost to mine increases exponentially also, the amount of energy you're using. So it was in 2022, we made a strategic decision to start selling a percentage of our monthly mined Bitcoin and kind of matched our sales with our operating costs. And the model kind of works that the higher the Bitcoin price goes, if we're able to manage our cost structure, then we should in theory be able to stack more Bitcoin the higher the price of Bitcoin goes. So we hold about 7,400 Bitcoin on the balance sheet, all mined by ourselves. And our goal is, again, as the price of Bitcoin goes up, we hopefully can sell less and stack more.
Is this working? Yep. Yeah. So our MC, Mag, said that she wanted this panel to be spicy. So I'll spice it up here a little bit. Again, as a 22-year institutional investor, I personally think like the Bitcoin HODL strategy is trash, okay? The reality is, right, you find one commodity company in the world, right, that any institutional investor invests in, Freeport-McMoRan, ExxonMobil, somebody that mines something that doesn't sell it because they think the price of it will be higher in the future. And look, I want Bitcoin price to be much higher just like everybody else here does, right? But we are a mining company, similar to I think what Ira said, and what we are paid to do is mine Bitcoin the cheapest as possible and then return that value in either additional CapEx growth that's accretive or reduction of debt or shareholder returns. But that is the model. It's just like any other commodity business I've ever invested in as an institutional investor. And so I think what we're going to see very soon is when the SEC does approve ETFs, the HODL model is over. Why would you ever buy a company that's diluting you to hold Bitcoin on their balance sheet when you can go in the market and buy an ETF that charges you 10 or 20 bips to own it, right? So it just makes owning Bitcoin so much easier, and that is coming soon. And so right now, the hurdle to owning Bitcoin outright, which is why miners have pursued the HODL strategy, is, if you have a Schwab account or an E-Trade, you can go online, you can buy a miner that HODLs. That's great. But as soon as that ETF comes around, which hopefully does drive Bitcoin higher for all of us, why would you ever do that? Just go buy the ETF, and now you don't have to open up a Coinbase wallet. You don't have to open up a MetaMask wallet. You don't have to worry about cybersecurity. You can, right in your Schwab account and right in your E-Trade account, own a Bitcoin ETF that gives you direct exposure to Bitcoin. So then the question becomes, why do you want to own a miner? You want to own a miner just for the same reason you want to own ExxonMobil or Freeport-McMoRan, because they mine the cheapest of all of their peers in and out of cycles. That's where we're going, I think, as an industry. Again, this is my personal opinion as a 22-year investor. Don't get me wrong. I want the price of Bitcoin to be a lot higher for all of us. I also want you to buy, all of our stocks that were sitting up here. I just think the HODL strategy, in my opinion, is over as soon as the SEC approves the ETFs.
All right.
Well, we have a very different view on this. Well, Marathon is the largest Bitcoin mining from an exahash perspective in the public company space, and we also have the largest HODL position when it comes to public Bitcoin mining companies. We have about 14,000 approximately Bitcoin, and that's valued about almost $500 million in cash and Bitcoin combined. So we obviously have a different view on this and different strategy when it comes to holding. Reflecting back on how we go about and make this decision, this is a management decision. We revisit this every month, and we look at what is the best value creation for the stockholders. Is it the HODL strategy? Is it the HODL plus monetization? And where we've landed is that we monetize Bitcoin up to the extent that we want to pay for our day-to-day operating costs. So keep the lights on and keep the operations going. And then the rest, we HODL that on our balance sheet. And that has worked out well for us. Reflecting on coming back from oil and gas industry days, certainly agree with Patrick's views on how ExxonMobil and other oil and gas companies, they monetize, they don't keep it. There are a couple of subtle differences there. One is that we are this is you don't need a physical space to store Bitcoin. This is an intangible asset. Oil is a physical commodity. Gold is a physical commodity. You need the space and the tanks to store it, and there's a physical limitation to that. Secondly, coming from, not meaning to be too technical, but most of the production here in the U.S. in oil and gas is secondary and tertiary, which means that it's through either water floods or steam floods, which means that storing that oil is very difficult. It's difficult to hold that in tanks. You have to keep heating that, otherwise it becomes tar. It becomes difficult to transport through pipelines as well. So some limitations there as well. The answer is somewhere in there in the balance. Reflecting a little bit more on the ETF, if you allow me to do that. ETFs is very exciting for this industry in the sense that it brings in those big boys and girls into the Bitcoin mining and investing space, and it allows other investors to allocate portion of their portfolio or assets into Bitcoin exposure, if you like. When it comes to the idea of whether this is going to impact Bitcoin mining or not, yes, it does, in my view, from a positive standpoint. But the investors will still want to invest in mining companies. ETFs do exist in oil, natural gas, and gold mining and other industries. That doesn't mean that investors don't hold individual company stocks, and that's where being efficient as an operator, deploying capital very efficiently. What kind of efficiency do you have from a machine standpoint? The miners that you operate, what kind of your operating costs are, and how much value you can create. All those things come into play.
Super interesting, very different approaches. And again, just for everyone who is here or at home, this is a new industry that we're building every single day. So those principles will be applicable for the next decade, and people will be talking about different approaches and different strategies. So it's very helpful to understand how each company is thinking about it. Let's talk a little bit about last year. So this has been a very eventful year for the Bitcoin industry in general and for the mining industry in particular. A lot of leverage, a lot of learnings about what leverage can do for a company's balance sheet. Going back to principles and treasury management, can we talk a little bit about what, if anything, has changed on each one of yours approach to treasury management, the concept of leverage? Has anything changed given what we've seen over the past 12 to 18 months? Any learnings that is important for someone who is starting, important for people at home, for investors to be aware that you have applied on your treasury strategy? Maybe we start now with Patrick. You want to kick it off, and then we can go across the room?
Okay, this topic isn't as spicy. But look, I think everyone in this room, if you've been around crypto for any period of time, and I, by the way, I like using Bitcoin. Crypto's a whole nother matter, but we're in the Bitcoin business. You're here. But look, counterparty risk, I think for all of us up here, it's like the number. People ask me, what keeps you up at night? My operations team kicks butt. I love them. Like our companies, finally just got our last expansion up online. So, it's been a great quarter for us. But the thing that keeps me up, and I'm sure Salman and everyone else on this stage, is counterparty risk, right? So as this business, and I think interestingly, like all of us up here have energy, power, commodity backgrounds. This business is a commodity business, and the number one input is power. That's it, period. So you got to go with the low-cost producer. And as we sort of navigate the space, right, the one thing that can go really wrong is if, somebody hacks in and you lose your Bitcoin, right? So we've done everything right. And so I think for us, and something we've all talked about, as a panel, as this industry matures, there's going to be a lot more hedging strategies that, Salman and I and Phil are familiar with in oil and gas, right? I mean, oil and gas companies, hedge out production multiple years, right? So we're going to get to that point, and that market is actually very deep. But right now, the issue for all of us up here is counterparty risk. So I can't go buy derivatives through Goldman Sachs, right? I can't do it through B of A, right? I've got to, when that market matures, and it's maturing at light speed, then this sector, I think, gets significantly de-risked from a counterparty perspective. But my number one focus as a CFO, like day in and day out, is minimizing counterparty risk.
Great.
Yeah, I would echo that. I mean, when I first started at Riot, every smart hedge fund manager was telling us to put our Bitcoin at Celsius. And, it was the counterparty risk. We didn't know who to trust, right? And so we were smart being conservative. And I think even today, we've just now started thinking about hedging because we have a big CapEx plan for next year to double our hash rate. And so we want to find ways where we can protect our cash flow. And I think similar to oil and gas, it's going to get more liquid. You're going to get more long-term duration. It's not going to cost as much. We recently looked at like a costless collar position where you could basically lock in $25,000 Bitcoin as your price so you don't have any downside. And then you could sell the call on the top side maybe as high as 35 or 40,000 because I think everybody's bullish about Bitcoin, so the call premiums tend to be a lot higher than the put premiums. So you can actually create a pretty neat financial hedge there where you can lock in. If we know we're going to sell 80% of our Bitcoin over the next 6 months that we mine, then we can lock in that price right now, lock in that cash flow, make sure that we can continue growing and pay our bills without having to go out and take on debt or sell more equity. And so I think it's getting better. What I'm really always excited about in the Bitcoin world is the amount of people that are leaving high-paying, class jobs, like from Goldman Sachs, from Morgan Stanley, and they're coming into the Bitcoin world and developing these programs, these exchanges. And I find one almost every week. I can't believe how many people are out there trading Bitcoin. It must be a pretty good business because these guys always have a lot of money. So I think it's going to get better, and that's something that we will, I think, eventually start working towards to minimize some of our downside.
Yeah, on the hedging front, probably can get a bit spicy. I mean, over medium and long term, who wins out of hedging? It's the financial institutions that offer the hedging products, right? They're not going to offer those products unless they're getting a good return on investment, return on capital, return on counterparty risk. So there's a lot of agency risk associated with hedging. Executives like to hedge because they can guarantee their profit margin for the year and their bonuses. So I think the dynamic around hedging, you need to be very careful. When you're going to hedge, you need to make sure it's at the right price on the power side or on the asset side itself, on the Bitcoin side. And I think you need to watch companies that hedge a lot because they're paying a lot away to the intermediaries. Yeah.
Yeah, just to piggyback on that, hate to give oil and gas industry perspective here, but we are in a product cycle where prices go up and down. So as corporations, we have to be prepared to take the advantage of the price when it goes up, and as the price goes down, we have to protect ourselves. So hedging is part and parcel of the risk management, just like the rest of the guys are talking about here. If you think about it from a number standpoint, oil industry, U.S. production is about, if I'm not mistaken, 40% hedged at any given point in time, versus Bitcoin is about 5%. So when you think about the industry has to catch up to get that commodity risk management. And as more mature players come into play from a hedging perspective, then the counterparty risk is addressed at that point in time as well. Marathon looks at it from a risk management standpoint. Obviously, we are long on the Bitcoin price for a long-term perspective. Yet at the same time, we do realize that there's a short to mid-term down cycle risk that we need to manage, and some of the products that Phil mentioned, we've explored those things and entered into several transactions like those in the past, and we'll continue to evaluate those things while still keeping our eyes on the upside and keeping the protection on the upside.
Great. Bear markets are for builders, as many say. Building in the Bitcoin space, especially in the mining space, requires a lot of capital. All of our companies have made big announcements this year, a lot of new projects, a lot of new expansions. I'd love to learn more a little bit about what each of your companies are building and working on, and how you're thinking about those projects from a financing perspective. How are you raising the capital? Is this debt? Is that equity? Just tell us a little bit more about large projects, especially for those at home who are listening to us and don't know that much about what you're building and how you're going about financing those projects. Maybe we'll start with you this time.
Sure, thanks. So in 2021, Riot bought a facility that was called Windstone at the time in Rockdale, Texas. That had 3 buildings, about 300 megawatts. And we immediately expanded that to 700 megawatts, 4 additional buildings. And so that was kind of our first entry into being an owner-operator. Prior to that, we had outsourced it. And we really felt like where the trend was going is that you can control your operations, control your costs. And what's unique about we're in Texas is the deregulated energy market. And so part of that was another way to hedge is to go out and buy long-term power contracts, PPAs. And so that's worked really great. We've been able to kind of play the energy game a little bit. We're able to monetize some of those hedges at times when power prices are high. And that's helped us be a low-cost producer, which is where we all want to be as a commodity business. So we then knew we wanted to expand. We bought a second property in Texas, a brownfield, where we went out and bought 275 acres, and we are fully approved for 1 gigawatt. So we'll have 10 buildings out there when it's done. We're building the first 4 buildings right now, and those first buildings will start coming online in the first quarter. So as we go into the halving, our hash rate will double, which will offset the halving effect of less Bitcoin. And the way we financed everything so far is through equity. And so, the beauty of the Bitcoin sector is the liquidity. Even in my best days at $100 oil, I've never seen stocks trade the way they do in this space. It's a phenomenon. I think it's worldwide. I get calls from people from all over the country that trade our stock. I could be at a restaurant and somebody hears me, I work at Riot, I trade your stock. Now, a lot of the times they don't even know what we do. I've gotten those calls where they're like, why is your stock down? And I'm like, well, Bitcoin's down. And they're like, what's Bitcoin? So it's a little bit of the yin and the yang. You take what you can get, but we felt that the equity markets and the valuations at times that we get, it's accretive almost from a book value standpoint for us to raise equity. We've been debt averse, leverage averse, and that allowed us during 2022, when Bitcoin was going down, to continue building this next facility. These facilities take 18 to 24 months from the time you start to the time you turn them on. And so it's you have to keep building and be ready. And so what's nice now is we have a clear, path of growth really till 2027 with this facility. So there's not a lot of businesses, let alone Bitcoin mining businesses, that can give you visibility for 3-4 years. And that's what we were able to accomplish during the downturn. And then we're bullish on Bitcoin and we go into the halving. And if Bitcoin goes to $100,000, we'll be able to lean in, buy more machines, and accelerate that hash rate growth.
Yeah, from Iris Energy's perspective, it's again about the scarce assets. So it take, 18 to 24 months to maybe build the facility and get permissions and that, but to actually find the facility, get the grid connection, deal with the utility can take 3, 4, 5 years. So we've got a strategy of building a portfolio of properties with large grid connections, and then using equity to build out the infrastructure. And then once the infrastructure is built, potentially tapping public markets to actually fill that infrastructure with miners or something else. So again, it's really demonstrating to the market that we've got best-in-class infrastructure, first and foremost, that we control, where we're vertically integrated, and then buying the miners at the latter end of that, as opposed to just getting hash rate up front for forward deliveries and hoping that you can plug them in and the infrastructure's ready. So yeah, no leverage. After 2022, I don't think any miner really wants leverage, so that we're there for the upside. We're there for the parabolic bull market.
Yeah, in our case, Marathon is probably the only one who has debt on the balance sheet, and we raised debt a couple of years ago, and very attractive rates, and we've been able to deploy that capital very efficiently, and the reason why we have grown so quickly is because of that capital that we were able to deploy. So very happy and proud of that. Now the question comes up, how do we see things going forward from here? From my perspective, halving coming up in the next couple of months, and the macroeconomic conditions where they are, we have to look at all the cycles, down cycle and up cycle. And from a down cycle perspective, we went out and reduced our debt by more than 55% at a very accretive and attractive transaction, thereby deleveraging our balance sheet. And when it comes to operations, we operate not only domestically but also internationally. So we're kind of in a unique position that we are not only in Texas and North Dakota, but we have very successfully entered into partnerships in Abu Dhabi, for example, with sovereign wealth funds and brought to life Bitcoin mining very, very quickly at a rapid pace without any hiccups. So we're certainly very happy with that, and we see growth, and we've publicly talked about certain near-term targets, more to come on that, and very excited about the growth, irrespective of the bull or bearish price cycles.
Yeah, look, I would say, as all of us up here, you can tell, this is a commodity business. Commodity businesses are all about economies of scale, right? You want big sites that allow you to drive down unit economic costs. So you look at all of us up here, right? We have 2 sites. We have one that's the first of its kind in the world, which is behind the meter at one of the largest nuclear facilities in the United States. So that's our first site. And then we have another site that's 30 miles east of Niagara Falls, right? And so both of those sites, we can expand significantly. We've got 160 megawatts online right now. It's about 50,000 miners. We have an expansion ongoing right now at our site in upstate New York by about another 50 megawatts. But everything that we are working towards is driving unit economic costs down pre-halving so that we can best compete and maximize profit on the other side. We also, Salman, similar to you, we do have some debt. Notably, like we put out a press release this week, we've started paying down that debt. Which I'm really excited about because, like you've heard from all of us up here, big sites, low, power cost, maximize profitability into the halving. And then I think, all of us have been growing, I think, accretively, organically. My view, again, coming from oil, gas patch, energy power patch over the last 22 years, right? In economic cycles, macroeconomic cycles, there's consolidation. And so we have a natural economic cycle in this business every 4 years, which is a little odd, right? It's not driven by recessions. So every 4 years, all of our costs up here double. And so right now, I look at the public mining space, there's 25 miners. Right? When I covered oil and gas companies when I was at Blackstone, there were like 50 oil and gas companies. Well, oil and gas went to $25 a barrel and $2 an MCF, and all of a sudden 50 companies went to 20. Right? And so that's kind of where I think this sector should go. The reality is all of us as public companies, we have public company costs that we can't avoid. But I can get a lot bigger, and those public company costs aren't going to change. And so I think that's what you're seeing all of us here grow organically and accretively. But to me, the next round is coming, post-halving, is there's got to be consolidation among the public companies.
Okay, let's get into the halving topic. Everyone mentioned a little bit. It's a very interesting topic for miners. But before getting into each one's strategy, how you're thinking about it, how you're planning to navigate, maybe one of you could just give a quick overview, especially for those at home who are learning about Bitcoin for the first time. Phil just mentioned people trading your stock and don't even know what is Bitcoin. I'm pretty sure a lot of people don't know what's the halving, when is it happening, the next one, and why it might impact miners. So maybe if you want to do a quick, very high-level overview about what is the halving, and then I'd love to hear about each one of your perspectives about how to navigate and what you're doing in light of 2024. Please go, Glenn. You want to give a quick overview?
Yeah, so the halving happens every 4 years. So the block reward every 10 minutes essentially gives us 6.25 Bitcoin at the moment, and that'll drop to half of that, 3.125. Essentially, that means that the rewards for miners are halved. So your revenue stream is halved in one go. And if the Bitcoin price doesn't rally or double, that essentially places a huge burden, I suppose, on a Bitcoin miner. In terms of the theory behind it, the theory is that over time, the network, the blockchain itself, will be utilized more for instant settlement or final settlement, similar to a SWIFT network, and that the fees will offset that over 5, 10, 20 years. We're not sure exactly when, and we've seen spikes in fees previously, which demonstrates that can be the case, and it can happen very quickly. It's not happening at the moment. It hasn't grown yet. We believe it will over the next 10, 20 years. Final settlement's very important. And we were talking about counterparty risk before, and reducing that counterparty risk is extremely important as well. How Iris Energy prepares for the halving, it's all about efficiency of your mining fleet, low OPEX costs. We have very few miners. We have very good infrastructure, so very few miners go down, need repairing. We do a lot of preventative maintenance on our transformers and our switch gears, on our substation, so that things don't go down, and we have near perfect uptime as a result. So all those little things mean that we're not spending out of pocket, and we can guarantee best-in-class margins within the industry. But it's always looking 3, 4, 5 years out. It's not trying to maximize bang for buck over the next 6 months by overclocking your machines 30, 40% and have them die 2 years rather than 4 years. So yeah, a sustainable business model that's around throughout the whole cycle.
Yeah, I would add on the halving, what I find really interesting, and a lot of times people only want to talk about Riot. We try to bring it back to Bitcoin, and just think how crazy Satoshi was when he created this, that every 4 years you're going to get half as much. Is it kind of coincidental that it's also only happens on leap years, right? It's every 4 years, and it's a presidential election cycle every year. I don't know if he meant to do that or not, but it's still kind of wild. And then something I learned about 6 months ago, which I just still find really interesting, 6.25 equals the percentage of Bitcoin that will be issued during that 4-year period. So when it goes to 3.125, the next epoch, the next 4 years, 3% of the remaining Bitcoin to mine will be issued during that 4 years. So you just think about the mathematics behind this, and yeah, your head starts to spin, and you're like, wow. And one of the questions I always get from people is, well, what's a miner going to do when there's no more Bitcoin to mine? And a lot of people don't know that it's going to take to 2140 to get that last Bitcoin. And then, to your comment about transaction fees, our director of research, our vice president of research for Bitcoin mining, talks about transaction fees and adoption. And I always make a comment when I'm out on the road to investors, and it's very similar to this crowd, is that we're actually the wrong crowd to talk about adoption, because we all have PayPal, Venmo, 3 credit cards, 4 bank accounts, 2 brokerage accounts. We're the most overbanked people in the world. But if you go international, it's way, way different. And that's what gets me excited, is the adoption phase of Bitcoin. We're all holding it as an asset class, but there's people that rely on it for their livelihood now in other countries to send remittances, to do commerce, to alleviate themselves from poverty. And so the altruism of it is what also gets you exciting, and I think it's one of the great parts of being in the Bitcoin industry.
Yeah.
Yeah, look, I would just add, if I'm anybody sitting in the audience right now, I would ask all of us one question, and that is, what is your unit economic cost to produce one Bitcoin today? I'll tell you, sitting up here, ours, you can go look at our results. It's roughly, depending on where the network hash rate, which is the total capacity online, ours is 20 to 22,000 right now, okay? Price of Bitcoin at 27, I'm making literally, somewhere between a 5 and 7 per Bitcoin profit, 5 to 7,000 per Bitcoin on every single Bitcoin I mine. So you should go down the line up here and ask all of us, what's your total fully loaded cost to mine one Bitcoin today? Because as my colleague down at Iris pointed out, a friend, excuse me, this is all about efficiency. So we're trying to get our fleet to be the most efficient, because when we go through the halving, right, my cost, if my fleet didn't get any more efficient, my cost goes overnight from 20,000 to 40,000. That's just how it works. And so what you need to understand as investors is, all of us up here, what's it cost you to produce one Bitcoin today, and what's it going to cost you to produce one Bitcoin after the halving event in April? That's it. It's as simple as that. Then you can figure out who you want to own.
Just to summarize that, the halving is a major event. It happens every 4 years. And we all have an ample amount of time and opportunity to think about it and be prepared for that. And look, historically, prices have caught up very quickly. We don't know if that's going to happen this time. We hope it will. In the long run, we hope that the prices are going to be great, but hope is never a great strategy. And the way to think about this is to be prepared for that. The global hash rate is likely going to be impacted as a result of miners probably going out of business for the reasons that Patrick alluded to. Cost per Bitcoin is important. Not only that, but also how efficient the machines are, because the technology has improved over a period of time. So more to come, lots of excitement as a result of that. Down cycles bring a lot of excitement, and learning from gold and oil and gas industries, companies who are resilient, they survive, and when they survive, they do extremely well. So the only people who survive are who know and how to go through these down cycles and be prepared for the up cycle.
Yeah. So we're getting close to the finish of our panel here, and we have about 5 minutes. Patrick, you gave some good advice on folks who are listening to us, planning to invest or get involved in the business. What is the one single question you should be asking yourselves and potential miners before investing? So I'd love to go into that topic a little bit and just get from all of you, if someone is at home or here in the audience thinking about, maybe I want to mine myself, how can I do that? Or I want to invest in a mining company. What is the one single piece of advice you have for someone getting to the space as an investor, as a participant, and trying to get involved? So a little bit of advice before we wrap up this panel.
Want me to start? Okay. So the way I see this is another asset class. As an investor, if you're investing in different categories, you got to think about Bitcoin as an investment category, and just like you would have, or our parents or grandparents may have invested in oil, gas, mining, and probably coal at some point in time. The same way, you have to allocate based on your risk appetite and portfolio. Look, this is a newer technology, and the use case of this industry is more to come. There's a lot to come, and it's being a nascent and a newer technology. Think about it from the perspective of internet in the 80s or the 90s. When I grew up in the 90s, and I just had MIRC or a few AIM and things like that, and that's about it. And now look at how that industry has evolved with a period of time. The regulations have gone out, matured, and now it feels normal. And people who had invested, early investors in those industries, they've created value for themselves. Obviously, this is not an investment advice. Use your own judgment. But from my personal perspective, this is an infancy stage, and there's a huge upside from here. And depending on how much appetite you have towards allocating your assets, it could create significant value like it has for other products and other technologies in the past.
Great, thank you.
Yeah, look, I kind of said my piece on cost, but I would just say I think this industry, right, needs more transparency. You look at what has plagued this industry, in my view, right? It's been, bad actors. Name FTX is obviously the easy one to point at. But all of us up on this stage, as Phil pointed out, I've spent 22 years as an institutional investor, right? And now I'm in a CFO seat. Like, the number one most important thing that we can provide people with is transparency, so that when you go look at what stock you want to buy, what Bitcoin miner, just like any other commodity business, you can figure out who's the lowest marginal cost producer among all of us. And so then you can also decide, hey, you know what? I think Bitcoin's going to 100,000. I want to be in the highest marginal producer because that stock is going to be whippier than buying the lowest marginal cost producer. But again, for you to be able to do that, all of us on the stage have to give you full transparency into what it costs us to mine a Bitcoin. And that's what we do at TeraWulf. I encourage you to look at all of our investor presentations. We give you every single cost in our company and what it costs us to mine a Bitcoin. And we try to do that actually on a monthly basis as well. And so I think until this sector gets that level of transparency, my former colleagues at Blackstone, Fidelity, BlackRock, they're not going to pull the trigger and come into these companies until they can look at them just like they look at every other commodity business in the world.
I kind of have a little bit of a different take just to make it a little spicier, but
Please.
I think the world has changed. And what I mean by that is when I got in the business as a broker, you didn't have a cell phone in your pocket. You couldn't trade. You couldn't access information on a second-by-second basis. And we, for lack of a better term, we've turned into a group of ADHD traders in the United States and around the world. And so I think the buy and hold mentality that our parents grew up with or other people, it's not really apparent in this sector. And so let's just be honest. It's the tail wagging the dog. If Bitcoin goes up, Riot could cure cancer, if Bitcoin goes down and Riot cures cancer, our stock's going down, right? So you have to realize that when you make an investment, a mentor of mine said you got to have an entry point, but immediately you should know when you want to get out of that investment. A lot of people buy investments without a strategy, without when am I going to take some money off the table? And then on the other side, when you do take that money off the table, you now have to think about where am I going to put that money at? So I'm pretty open with our investors, and I basically say we're not in this business for $25,000 Bitcoin, and you shouldn't be either. Either you believe in the long-term value proposition, the scarcity proposition, you believe that it's going to be a six-figure, Bitcoin at some point, and then you want to go then to the fundamental side and look for those miners that are the best at what they do. And so for the first half of this year, our cost from an operations standpoint was about $9,000 per Bitcoin. If you add in G&A, it was just under $15,000. So we're in the top tier as far as costs. But quite honestly, if Bitcoin is up tomorrow, all the stocks move in unison. You'll start to see a little bit of difference in the multiples. And we've seen that with people that maybe have leverage, have debt, have higher costs, and you're starting to see some correlation. But it takes a lot more work. And I just met with Fidelity, and they're looking at Bitcoin miners. But everybody is still kind of waiting, I think, for this aha moment. But in my opinion, when that moment happens, you might already be too late. So go buy Riot.
So yeah, from my perspective, like, you don't invest in Bitcoin if you've got high time preference. That's how you lose money. It's the same with miners. The incentive for management is to have high time preference, to grow your hash rate very, very quickly at all costs. So when looking at a company, you should be looking at management that obviously have low time preference. They may grow a little bit slower. They may invest in real world infrastructure that can last a very long time, and that's not going to be depreciated over a short-term basis. The panel before us were talking about miners and Moore's law. Like, every 2 years, the S21, the new miners, are almost twice as efficient as the previous model in 2 years. So, like, you got to look at the balance sheet of the miner. What is on their balance sheet? If it's 90% miners and they're getting double as efficient every 2 years, that balance sheet's worth jack. So I think these are the type of things you need to, if you're putting hard-earned money down, you need to be looking at what you're investing in. And it's not always just the hash rate, and it's not always the last monthly report as well. I think transparency is very key. Looking at the monthly reports, you can quickly see who has good transparency and who doesn't. They're 2-page reports, very easy to read. You don't need to go through a 100-page F20F or whatever else. So yeah, they're my recommendation.
Thank you so much. Please, a round of applause. Doesn't get much better than this. Salman, Patrick, Phil, and Glenn, on behalf of Swan and Pacific Bitcoin, thank you so much for joining us.
Oh, hi. Do you have your ticket to the next Pacific Bitcoin Festival? Join us as we shine a light on the best of Bitcoin and Bitcoiners. Visit pacificbitcoin.com for the best deal on tickets now.